The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A potentially calm week on the data front. Well, it belies the torrid paddling underneath the surface. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic.
And I'm Matt Miller. We're kicking you off to the closing bell here in the U.S., where we once again see all-time highs on the S&P 500. If you look at the NASDAQ, if you look at the Dow Jones Industrial Average, you'll see the same thing, although not the Russell, because the small caps had a rough Friday. Bitcoin is off by 2.5%, but still at $112,500, so relatively high level there. Gold, on the other hand, climbing to $37.48 a troy ounce. That's a new all-time high for the yellow metal. And the 10-year yield not moving by much, but right now at 4.14, I should say. Romain, we saw a drop for only a few minutes below 4%, and since then we bounced back.
Yeah, and the price action is kind of wonky here on this Monday afternoon. The sentiment actually moves the market much more given the absence of hard economic data or corporate earnings this week. Take the moves in a safe haven like gold that Matt was just pointing out, that's at a record high. Then you take the moves in risk assets like Matt was pointing out in stocks, that's at a record high. That's actually not supposed to happen. The correlation typically negative, with one rising as the other falls, but a softer dollar, growing bets for more rate cuts combining to create some strange market bedfellows. You're also going to see that push-pull playing out today in the bond market, where after successfully front-running the Fed's first interest rate cut in 9 months, fixed income traders now riding into the foggy road ahead by buying the belly of the curve. Middle maturity treasuries that throw off interest payments and are more insulated from the rapid-fire reversals to the economic outlook. Meanwhile, you have Trump's newly installed Fed Governor, Stephen Miron. He's making that speculation even more layered today. An interview here in New York where he downplayed inflation concerns and made the case for aggressively cutting rates in the coming months to protect the labor market.
The upshot is that monetary policy is well into restrictive territory. Leaving short-term interest rates roughly 2 percentage points too tight risks unnecessary layoffs and higher unemployment.
Yeah, not the most scintillating speech in the world, but the substance was certainly there, Matt.
Yeah, really interesting that he wants to cut rates so far below what most people consider the neutral rate, even though in his position as head of the CEA, he's forecast 4% growth in 2027. This is one of the things driving the market. The other thing is that we have earnings that just continue to power higher than expectations. This is the EEG function for the S&P on the Bloomberg terminal, and this was Q2. You can see that we came up so much to 67.33. Now we're looking at Q3, which is going to kick off in a few weeks at 67.76. That's about 7% earnings growth. But we need that to come up to double-digit earnings growth before we can fulfill these incredible price-earnings ratios. Right now, trailing at more than 25 times, which isn't as high as the dot-com bubble, but is much higher than the average over the last few decades. Romain?
Yeah, and this is one of those sort of moments in the market, that inflection point where it really pays a lot to sort of really look into those charts, look into the data a lot deeper. And one guy who does that better than anyone is Jurrien Timmer, Director of Global Macro over at Fidelity Investments, joining us here in Studio 2 in New York City. Great to see you.
Good afternoon.
It's been way too long. I mean, Matt kind of hits on a point here. I mean, we talk about a market at record highs, a market that seems to think we're going to continue to hit new record highs. But is our corporate fundamentals, corporate earnings for that matter, going to be supportive of that?
They are right now, and as Matt suggested, the growth rate for the earnings estimate going into the next earnings season is 7%. It's been there for a long time. Typically, you get a pretty good bounce. In the last few quarters, we've gotten a very good bounce. So chances are that 7% is going to end up as a double-digit earnings growth. And then we've strung together quite a few quarters of double digits. And so the markdowns from the tariff tantrum in April, where the 2025 growth rate went from 12.5 to 7, is now back up to about 9.5, and that is what we need because the market is not cheap. So you need earnings to do that heavy lifting. And for the first couple of years of this bull market, which is now almost 3 years old, it really has been the PE side.
Yes.
The trailing P is up 55% since October 2022. Earnings are only up 22%. So they need to bring it up.
But how do we do that if we are under the assumption that economic conditions, if not weakening, certainly aren't strengthening?
So there are a number of cross currents. Of course, we have the tariffs. They're kind of on the back burner now. We have the one big beautiful bill, and that R&D expensing has certainly been a powerful driver for margins, at least for large caps. We have the AI boom, which is sort of a vague thing that is hard to quantify. And then we have, of course, the jobs market, which has been soft in the last couple of months, although the ratio of sort of job seekers to job availability is pretty much in balance. But if you look at that pendulum that keeps always swinging from tight labor markets to too much labor demand, it's certainly heading in that direction. And I think the Fed has heeded that signal when it cut rates a quarter point. In your note, you talk about financial repression. You say that's what the Fed is doing right now. That's what the government's doing. They have this massive debt that they need to sort of inflate their way out of. Part of that is weakening the dollar. And that, I guess, would be a tailwind for U.S. corporate earnings as well, right? It would. So fiscal dominance, where it's fiscal policy that really drives the bus. And then in its purest form, monetary policy sort of takes a back seat. And the 1940s was a very good example of that, where the Fed actually was not independent, and it actually helped the Treasury to fund the debt by capping rates at 2.5. So the Fed's been not independent before? The Fed, was not independent before 1951, the Treasury-Fed Accord. And so back then it was, the Congress spends the money, the Treasury finances the deficit, and the Fed helps the Treasury do that. Obviously, the Fed is now independent, and we're not in financial repression right now. That's not so obvious, Jurrien. Well, at this point, maybe a year from now it will be more obvious, but or less obvious. But at this point, I think the Fed is conducting independent monetary policy. There's no QE, but we'll see if that changes. But right now, my sense is neutral is about 3 3/4. Yeah. Inflation's 2 3/4. The neutral rate is about 100 basis points. So I would not characterize monetary policy as restrictive. I think it's very near neutral, and that's probably where it should be. Yeah, I'm having a hard time seeing where the restrictiveness is. But on that point of independence, too, I mean, it's kind of funny, too. I mean, today is kind of the 40th anniversary of the Plaza Accord, and we talk about the idea of the Fed, the Treasury, central bank, finance ministers sort of working in concert to achieve their goals. I know we're nowhere near that now, at least not on a global basis, but internally here within the United States, there does appear to be a little bit more of the White House sort of taking the wheel, or at least trying to put their hand on the wheel in a way. I don't want to get into a debate whether that's good or bad, but I am curious as to your thoughts as to what the potential outcome might be. Does that just basically mean the market should bet on a softer dollar and on lower rates? Yeah, so I think a softer dollar seems likely. Whenever a country, whether it's Japan just in recent decades or any other country, tries to control interest rates, by keeping monetary policy looser than maybe it's warranted, the currency generally, takes a hit because you can't control everything. You can control short rates, obviously, in terms of the Fed. You can control long rates to some degree by doing balance sheet expansion, but you can't really control the currency. So, and the dollar shows you that, right? You look at a weekly chart of the DXY. It's forming a wedge right at the lows, and it looks like it wants to go lower. We feel like the BBDXY is a better measure of dollar strength and weakness. Jurrien, you mentioned in your research gold and Bitcoin, which have already come so far so fast. Are you still bullish those if you think that the Fed's going to lean towards labor and let inflation run hot? Yes, I am, and I do think that that's exactly what will happen. And in that sense, we talked about the 40s earlier. The late 1960s is an interesting parallel because that was a period of chronically loose fiscal policy, so deficit after deficit. And it was chronically loose policy, not because it was fiscal dominance. The Fed was independent, but I think the policymakers just didn't see the threat of inflation until it was too late. And so in that scenario, the dollar comes under pressure. Of course, we ended up losing the gold standard around that time. So this harkens back to that. And especially if we really go into an overt fiscally dominant era where monetary policy is just looser than it otherwise should be, then you get gold going losing the dollar losing some of its reserve status, and then gold and Bitcoin are on the other side of that trade.
All right, you're going to have to leave it there. Right now, looking at gold at record highs, stocks near session highs. Jurrien Timmer, Director of Global Macro at Fidelity Investments, kicking us off to the close here on this Monday afternoon, coming out of a weekend where we saw a lot of chaos and confusion surrounding the H-1B visas here in the United States. That discussion coming up after the break. This is The Close on Bloomberg.
President Trump's massive overhaul of the H-1B visa program with a $100,000 fee per application will most likely damage the offshore IT services model. Companies like Tata Consultancy Services and Cognizant may be forced to redesign their pricing plans to offer an expensive onshore consulting model or a cheaper offshore program. Anurag Rana, senior technology analyst at Bloomberg Intelligence, has been covering this for us. And Anurag, this is a sector that you've been analyzing for quite a long time, and until now, it cost nothing to bring in much lower cost workers, maybe even better educated workers from overseas. Now, what are tech companies that rely on, especially for IT services or healthcare services, these people going to do?
I think it's going to be a very different way of doing business for them. So, for example, if you were installing an SAP software, you would have a mix of people onshore, on-site versus the one that are implementing some of the stuff from low-cost countries. I think the companies will have to figure out whether they're going to have a fully fully onshore model or a fully offshore model, because it is going to be very difficult for companies to hire workers given the band of compensation we have, and on top of that $100,000 fee. So I think it's going to be very difficult to do it that way now.
I am curious, Anurag. I know it's still early and there's so much we don't know about what the Trump administration's ultimate aims are. But is there a sense that companies can maybe wait this out? The idea that we're already hearing about potential exemptions for doctors, maybe we get some exemptions for certain types of tech workers as well.
Yeah, and another thing you have to think about is the next lottery is not going to happen right away. It's going to, we are already tapped out for this year, so it's going to be more beginning of next year that we will see when companies start to file for new applications. This does not apply for renewal, so it doesn't matter if somebody needs a renewal in between, so that's fine. But what's going to happen is next year, when companies are thinking long and hard, going to their end clients, whether it's a bank or a hospital system or a retailer, and saying, okay, you and I went and did a deal for implementation of this software, and the way we did this was I'm going to have 10% of my staff onshore and the rest of them offshore, but that pricing doesn't work for us anymore. We have to redesign the program and see how are you going to do, or what kind of work you need to get done on these pricing.
So these companies have thousands of H-1B visa workers, and we know that almost half of the program goes to outsourced IT workers. What are they going to do if they can't bring these people, if they decide they can't afford to, especially smaller companies? Do American workers have the education, the skills necessary to fill these jobs?
See, I think, obviously the engineers in the U.S. are qualified to do a lot of that work. But the issue is not so much the skill set there. The big question is whether there is the capacity. It's more a volume game in terms of, I think the number of graduates per year in the U.S. are less than 100,000 when it comes to engineering and, those kinds of jobs. Well, somewhere in India and China, that number is, north of 500,000 or even close to 1 million, depending on, what you bucket into that. So it's more so a numbers game rather than, just a matter of qualifications. But there is no doubt in my mind there is a massive shortage of tech workers in the U.S.
Anurag Rana over at Bloomberg Intelligence, taking a closer look here, what could potentially be a big hit to some of the tech companies out there that rely on this model. And Matt, there's been a lot of talk over the years, long before the Trump administration came about the H-1B program, visa program, and whether it was even equitable to begin with.
Yeah, that's right. The problem is a lot of firms, especially multinational outsourcing firms, have been gaming the system. We had a story by Eric Fan and Zach Miter last July that pointed out more than 15,000 of those who won the H-1B visas in 2023, and there were only 85,000 that year, had applied multiple times, like many multiple times.
Yeah.
So essentially cheating in order to get those visas. And this could be one way to stop that from happening. Although, of course, then you have to pay up and only the biggest firms can really afford it.
Well, that's the other thing. It's like you take one system that's inequitable and maybe replace it for another system that's also inequitable, just with a different
At the end of the day, as we've been seeing with tariffs as well, the big companies will be able to deal with this. The smaller companies lose out and may have to fold up.
Yeah, a developing story here that could become a much longer story in the days, weeks, months, and years to come as we continue to count you down to the closing bell here on this Monday afternoon. We're going to take a look at some of the big calls by sell-side analysts today, including in the apparel space, shoes specifically, Crocs and Steve Madden going in opposite directions. We're going to talk to the analysts behind both of those calls when we come back. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Brinker International. Wells Fargo upgrading the parent company of Chili's to overweight and nudging the price target to $175. The analyst saying management's current fiscal year comp sales and EPS forecasts are, quote, beatable, particularly with new food items like ribs and the queso relaunch. Those shares up 1% on the day. Next up, Keurig Dr. Pepper, BNP Paribas, Exane, cutting to underperform. The only sell equivalent rating among the 22 analysts covering the stock. The price target also going down to a street low $24. BNP citing risk around earnings and the poorly received $18 billion acquisition of the parent company of Peet's Coffee. Those shares down a third straight day and now down more than 15% since that JDE Peet's deal was announced back in August. Finally, Lennar, Raymond James downgrading to underperform. Only bearish analysts out there on the home builder saying the market is underestimating how long it's going to take Lennar to restore its margins. The analyst, though, did say shares could rise if mortgage rates fall unexpectedly and fast. Shares of Lennar, though, falling fast on the day, down about 4%, down a fourth straight day, and those are some of our top calls. We do want to stay in the consumer space because our next guest is out with her own pair of retail names today, downgrading Crocs to neutral and slashing the price target to $75. Concerns there about what's going on in the U.S. Meanwhile, an upgrade for Steve Madden to overweight and a price target going up to 40 from 25. Let's bring her into the conversation right now. Andreeva joins us, Piper Sandler's Managing Director of Equity Research. And Anna, I do want to start with Steve Madden because this has been a bit, at least to me, of a surprising move upward that we've seen in the shares over the past few weeks and months. A stock and, quite frankly, a brand that had been in a bit of trouble over the last few years. How have they turned things around?
No, great to be here. Thanks for having me. So with Steve Madden, we think it's a really interesting kind of a smaller cap idea in the space. So as we think about what's been happening with tariffs for the space this year, this has really been a perfect storm for Steve Madden. They were highly exposed to China, moving away from China, moving into places like Brazil that got tariffed, higher. So kind of navigating a very difficult backdrop, and profitability of the business got cut in half. This is a 6% operating margin business we modeled this year that really structurally should be low double digits again. And we don't see why that wouldn't be happening into 26 and beyond. And the good news, as they stabilize the production, there is a cycle happening in the industry away from casual and more into dressy type of categories. And Steve Madden is a really interesting, kind of akin to a fast fashion business model. They turn inventories 8 to 10 times a year. So when there are trends in the industry, this is a company that can benefit from those and interpret those, very quickly. So you're starting to see that specifically the dressy and the boot cycle is happening for the first time in a couple of years now. And into 26, we believe the company is going to be growing sales again, and profitability will follow as well.
I am curious, Anna, what is Steve Madden's relationship right now with third-party sellers? Has that relationship improved?
You mean with their wholesale partners?
Yes, with their wholesale partners, excuse me. Yep.
Yeah, so, that's a great question. So a pretty significant portion of their distribution is off-price. And off-pricing was, cutting orders when the tariffs were just at their peak. And, since then, the environment has normalized. And we think off-price, which is basically a distribution channel where Steve Madden makes product for that particular channel, that channel is starting to grow again into 26. And the one really interesting part of the story is also the acquisition of Kurt Geiger that they made this summer, which we think is a really interesting kind of underappreciated opportunity and a brand that is starting to grow here in the U.S. and we think has a lot of momentum.
I wonder about Crocs. This is a brand that already has had substantial growth in the U.S. I see all the kids wearing them when I drop off my daughter at preschool, and I see an unfortunate number of adults wearing them when I go to the airport to fly places. This is a company with a PE of less than 6 trailing. Forward PE is only 6.8. I mean, how much lower can the valuation on this company go?
Yeah, we're not necessarily arguing that the multiple contracts. We just worried that the multiple could stay at these levels and, the stock would be range bound as a result. So here at Piper, we do the teen surveys that we've done, for a number of decades now. And according to the survey, the brand, started losing some heat, specifically with the teen consumer. I definitely think you're right. The younger customer adoption of the brand, it's still pretty significant. But then as this consumer ages a bit, you start losing that. And I think we're starting to see that. And, Crocs has done a really good job diversifying away from clogs. They've talked about the sandal category that is growing really nicely. We think double digits, but it's still a pretty small percentage of their mix. And the overall, clog industry, according to our research, is actually still growing, pretty nicely. But the problem is there are new entrants in this category. And we think, Crocs brand here in the U.S. is starting to lose some of that momentum.
Can Sydney Sweeney help, Anna? I mean, is Hey Dude going to be a help here?
Yeah, no, the Sydney Sweeney relationship, we believe, is ending actually by year end. And, Hey Dude has had its struggles as well. Pretty low brand awareness, especially if you go kind of outside of the core, middle of the country type of a markets, especially on the West Coast and, the Northeast as well. So we think, additional marketing may be needed. And, Crocs overall has had very solid, profitability, but unfortunately that's been eroding. Right. And, marketing for Hey Dude and turning Hey Dude around, that's been part of it.
Got it. Anna, great to talk with you today. Anna Andreeva there, Piper Sandler's Managing Director of Equity Research. Hey Dude is the subsidiary that Sydney Sweeney did the ads for before the jeans.
Before the infamous jeans.
Yeah.
She's everywhere.
She is. She should be everywhere. We need more of Sydney Sweeney.
Why, Matt? 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Matt Miller. We are looking at equity indexes that are at an all-time high again. Yeah. Not the Russell 2000, because it had a rough day on Friday.
Yeah.
But it is up. But the S&P, the NASDAQ, and the Dow Jones Industrial Average all hitting new highs.
When is the Russell ever going to get its mojo back? Because remember they had that big outperformance a few days ago, and everybody said this is it. Finally small caps.
And the first time we saw all 4 of those indexes close at an all-time high on the same day since 2021. It's only happened like 25 times in the whole century.
Yeah.
But I don't know. I feel like Fed cuts should help.
Yeah.
Right?
Well, you hope so here, but at least for today, it seems like everyone's back into big tech and back into the AI trade. In fact, you talk about NVIDIA shares today trading at a record high on an intraday basis, potentially maybe paving that road to superintelligence. We learned a little bit earlier about a fresh $100 billion investment that the company's making in OpenAI, a partnership meant to expand compute infrastructure as hyperscalers race to make AI smarter. I had actually a chance to catch up with the godfather of AI, the Nobel Prize-winning physicist Geoffrey Hinton, now professor emeritus over at the University of Toronto. We talked about the meteoric rise of the technology that he helped pave the way for and, well, some of the warnings that he's giving folks for the future. Take a listen.
There's a bunch of people, mainly former academics, worried about safety. So many of the real experts in this stuff really believe we're getting superintelligence coming, and it's very scary unless we do it very carefully.
You, almost a year ago, I believe, October of last year, of course, you were awarded the Nobel Prize largely for your work that effectively laid the foundation for a lot of where we are today when it comes to artificial intelligence. When you look at the general models that are being used, and I don't necessarily mean the technological models, but the business models that are being used by various companies, do you see some of those companies as being more responsible actors than others?
Yes. First, I want to correct something. There were quite a large number of people contributed to artificial intelligence. I was just one of them. I think some companies are more ethical than others. Anthropic was set up to be more ethical than OpenAI. It was set up by people who left OpenAI because they didn't believe OpenAI was living up to its mandate to develop it with safety as the first principle. Anthropic is very concerned with safety. DeepMind, which develops Genuity for Google, is fairly concerned with safety. Demis Hassabis, who runs DeepMind, has been concerned with safety for a long time and is very well aware of the issues of how dangerous a superintelligence could be. Some of the other companies are much less ethical, in my opinion. In my opinion, Meta and Elon Musk's company, xAI, seem to be much less concerned with developing stuff safely, even though people like Elon Musk do understand the risks.
When we talk about those potential risks, I am curious about your past relationship with Google and what is effectively now DeepMind. You sold your company to them more than a decade ago. However, you also left quite some time ago as well. Why?
Okay, so I didn't leave in order to criticize Google. I got along very well with Google. While I was there, I believe they were operating about as ethically as a company could. For example, they developed these large chatbots before anybody else, the ones that use transformers in 2017, developed in 2017. And by a few years later, they had very good chatbots. They didn't release them to the public. But when OpenAI made a deal with Microsoft and they were released to the public for search, for Bing, Google had no alternative but to compete and make them public.
I am curious about your thoughts on the reliability of a lot of what we're seeing with regards to AI and specifically the agentic side of it. Obviously, for the consumer and for a lot of us, our first sort of exposure to AI are through chatbots. There have been a lot of discussions about whether those chatbots are actually delivering us real information, whether they're just simply reinforcing our own personal thoughts and beliefs as we sort of enter prompts, and whether they are truly thinking for themselves. Can we rely on what they're telling us?
No, you can't rely on what they're telling you any more than you can for a person. So one of the problems with chatbots is what was called hallucinations. For language models, it should be called confabulation. And it's been studied by psychologists for a long time in people. So we know that when people remember things that happened some time ago, they actually make up a lot of details. And they're perfectly confident in these details, even though the details are wrong. You don't often see that, but it was very clear, for example, when John Dean testified in the Watergate trials, he didn't know there were tapes of what went on in the Oval Office. And he confidently described meetings in the Oval Office that never happened. And it doesn't look like he was lying. It looks like he was trying to tell the truth. He just said what seemed plausible to him retrospectively, given his experience in the Oval Office. And he characterized what went on very well by making up little scenarios that were typical of what happened, but weren't actually what happened. Now, chatbots do that too. And the fact that they do that just makes them more like people, not less like people.
Would you like to see a little bit more coordination amongst the world governments, whether it's through a body like the UN or something maybe new and similar to that, to maybe provide, if not guardrails, at least a little bit more guidance as to how we develop?
Yes, I would like to see actually a lot more guidance. The problem is that on many of the dangerous misuses of AI by people, the governments misalign. So, for example, the United States and China aren't going to collaborate with each other on how you do the best cyber attacks. Their interests are exactly opposed on that. They'll never collaborate on that. They're not going to collaborate with each other on how you build better autonomous lethal weapons. Their interests are misaligned on that. There is one issue, though, on which all countries have an aligned interest, so will cooperate, and that's preventing superintelligent AI from taking over from people. No country wants that. The American government doesn't want that. The Chinese Communist Party doesn't want that for sure. So they will collaborate on that.
But there are a lot of people out there, as you know, Professor, that believe that that's probably inevitable, maybe not in a whole, as in 100% of all of our jobs and tasks. But, I mean, you even go back to some of the early writings of Keynes and a few others, this idea that maybe some form of artificial intelligence replacing, or technology, I should say, replacing our day-to-day jobs, if you will, that basically frees us up to be creatives and artists or whatever else out there. Is that a fantasy?
It's not entirely a fantasy. That would be great. On the face of it, if AI can greatly increase productivity, then there should be more goods and services for everybody, so everybody should be better off. We would have to work less. We'd be more free to do the most creative things we do, or the most human things we do. But we live in a particular kind of society. It's served most of us very well so far. But in that capitalist society, unless it's well regulated, what's going to happen is artificial intelligence is going to make the rich a lot richer, and a lot of people will lose their jobs. That's what I believe. It's not certain. Some economists disagree. I think they're wrong.
And that was Geoffrey Hinton, Professor Emeritus over at the University of Toronto, who won a Nobel Prize almost 1 year ago, October 8th of last year, for his work on models that effectively laid the foundation for artificial intelligence. Matt?
Yeah, absolutely fascinating. We have some interesting breaking news here as well. Disney saying in an emailed statement it plans to return the Kimmel Show to air on Tuesday. Joining us now to discuss is Bloomberg Chris Palmeri. And Chris, Disney says, you know, they took this show off the air because they thought things were getting a little too heated and thought Kimmel's comments were maybe ill-timed and insensitive. Why do they think Tuesday's the right time to bring him back?
Well, this was just sort of a cooling off period. This is actually what some of the station owners had asked for. There were a lot of people calling into local stations, whether it's Salt Lake City or wherever, saying that his remarks were insensitive. And so Disney felt it had to act. That was Wednesday. There have been discussions at the highest level, we understand, from Disney CEO Bob Iger and Dana Walden, the head of TV, directly with Jimmy Kimmel himself over what the future would hold. Right now, we don't have any details in terms of what he's going to say on Tuesday, but part of that has, there have been calls from some of the station owners for him to apologize to Charlie Kirk's family, even make a donation. So whether that happens, we'll wait and see.
So, Chris, I am curious here. What is the future? When we heard about the suspension, there was a lot of talk about the fact that Kimmel's contract was up at the end of the year anyway, I believe. So when we talk about this return on Tuesday, should we assume that that's going to be a temporary return?
It's pretty obvious that the late night comedy format is challenged. Stephen Colbert is going off the air next year. You can decide whether that was based on politics or financial decisions. CBS had said it was a financial one. The Kimmel Show is also losing money. These shows are just not getting the audience that they used to, and they're very expensive to operate. And so you can expect probably that this is not, a lifetime job for Jimmy Kimmel.
I am curious, though, assuming that they do get rid of Kimmel, is this the idea that they would replace him with another late night host, or are they going to basically just walk away from this, at least the traditional late night format altogether?
I think that's very much the direction they're heading without replacing the show.
But they would walk away. So Chris was talking with Lucas Shaw about this the other day, or we were exchanging Bloomberg messages, and he made the same point that you did, that this show loses money, that Colbert lost money. But there are some benefit to the network of having these big name shows that bring celebrities in, right? Is it possible that it's valuable to them even if it costs $10, $20 million a year?
I think that's one of the reasons why they've stayed around as long as they have, but there's all these other ways to get that message out with social media and that. And so having these expensive late night shows is maybe not the best format going forward. I don't think Disney's made a final decision on the program, but it definitely doesn't appear to be a long-term thing for Jimmy Kimmel.
All right, Chris, thanks so much for joining us. Bloomberg's Chris Palmeri talking about Jimmy Kimmel. He will return to air, according to Disney. That comes on Tuesday night. Keeping with this story, we're taking a look at the stock reaction. The shares are coming off of their session lows. A little bit of a bounce here, though still in the red. Here to break it all down for us is Bloomberg's Norah Mulinda. Norah?
Definitely still seeing shares of Disney here in the red. They are down about a little bit lower than 1% right now. And of course, people are really trying to digest this new news that we're going to be hearing about Jimmy Kimmel coming back here. And of course, you're seeing the street trying to decipher what to do with this. I mean, if you think back to the past week, we had a lot of celebrities that were actually canceling their Disney Plus subscriptions as they were thinking about what the implications are of the fact that they're taking Jimmy Kimmel off the show, or they were.
They must not have kids.
Yeah, I mean, they must not have kids.
If you have kids, you cannot
stick
cancel.
with it.
Yeah, there's no way.
There's so many options on there.
But I am curious about this. I mean, Jimmy Kimmel doesn't necessarily move the needle when we talk about the bottom line for a company of this size. But when you start to see people saying, okay, I'm canceling my Disney Plus subscription, or I'm not going to, go to Disney World or partake in any of the other Disney properties out there, whether that's real or not, who knows? But I do wonder if there's any evidence that any of this does add up to a point where the next earnings report that we get out of them, we do see some material weakness.
I mean, it's definitely an active protest that we're seeing here. We saw so many people coming out and making comments about the fact that he was being removed from the show. So, I mean, as to whether or not that actually filters out into implications for the bottom line, I mean, that's what analysts, of course, have to kind of figure out here in this particular scenario. I mean, if you're looking at the A&R page and you're seeing what Wall Street is thinking about this stock, 32 analysts have a buy rating on the stock. Only 1 has a sell, 7 have a hold. So, I mean, that kind of tells you what Wall Street thinks about this company right now.
Yeah, I'm looking at the share performance, and over the last 5 years, it's done a whole lot of nothing. This year to date is as well. But over the last year, it's up 20%. Over the last year, it's up 2 years, it's up 40%. So they're on kind of a run now. It looks like the market, pricing them at, I think, 20 times forward earnings, wants to give them a little bit of a chance.
Most definitely. I mean, that's what it seems as though, a little bit of a chance. And to go back to what you were saying about the year-to-date performance, up 1.3%. So, I mean, if you look over the past 5 years, as you're mentioning here, not a crazy amount of activity, but you are seeing a little bit of the pop in the green as you look about what the performance has been like here in 2025.
We've seen a lot of media stocks moving over the last few months. Some of that just based on, obviously, acquisitions with Paramount, Skydance, and whatever the heck's going on with Warner Brothers, but also just a whole rethink here of exactly what the future of television looks like. And we've seen not only Disney under pressure, but a lot of the other properties out there under pressure as well. Is there a sense, though, investors even care about these companies in the traditional sense? I know there's always going to be investors, but the idea that a lot of people have moved on to social media companies or other, I guess, kind of new media, for lack of a better phrase, that is capturing. I mean, Chris Palmeri was talking about this idea, or I think it was Matt, I'm sorry, it raised the idea of like, oh, all these people watch it. But, it was like a couple weeks ago, my son was watching, the whole Kai Cenat stream, and all these celebrities, it was like Mariah Carey and the Jonas Brothers and everything else.
Oh, yeah.
I mean, celebrities have other places to go now where they can get eyeballs in a way that in the past, you had to go sit on the couch next to a Jay Leno, David Letterman, or in the modern area, Colbert or Kimmel.
Absolutely. I mean, it was as I was hosting Bloomberg Business Week last week, we had someone come on. We were talking about the idea of so many people are moving away from broadcast. And so when you think about where you can actually go for advertising, if you think about influencing, if you think about the fact that celebrities are really trying to push their brands, you see a lot of them going towards social media or quasi-social media platforms. If you even think to TikTok, right? I mean, that's
we're
been
talking
a major
about a Twitch stream, and everybody, you have old people scratching their head like, why would these big celebrities go in there? I'm like, do you know how many streams this is getting?
The platform is there.
Yeah,
the visibility.
And it's repeatable because, people go back and watch that in a way that they're not necessarily going to do for a late night show.
Do the kids appreciate Mariah the way we appreciate Mariah?
They go back like babies and pacifiers.
She's on fire.
I surely hope so.
Norah, thank you so much for joining us. Norah Mulinda there on Disney Stock. We'll continue to bring you headlines on that breaking story. Jimmy Kimmel returning to the air.
At this point, I think the Fed is conducting independent monetary policy. There's no QE, but we'll see if that changes. But right now, my sense is neutral is about 3 3/4.
Yeah.
Inflation's 2 3/4. The neutral rate is about 100 basis points. So I would not characterize monetary policy as restrictive.
Jurrien Timmer over at Fidelity Investments kicking us off to the close just about 50 minutes ago, and certainly nothing restrictive right now about what's going on in the equity market. A third straight day of record highs.
Yeah, record highs everywhere you look, and if you type FCO and go, financial conditions on the Bloomberg are very loose right now. But we see part of that is the rally in stocks, you know, and part of that also is that you've seen 10-year yields come down so much. Now, 4.15 doesn't seem low compared to last week since we dipped under 4, but we were getting closer to 5 earlier this year. And when we would have people on, like Secretary of the Treasury Scott Bessent, saying, you know, getting to 10-year yield down is one of my primary goals, it seemed like it wasn't going to happen. And now you're seeing them really achieve that.
Yeah, you're seeing them achieve that. They also came in talking about the dollar and how it needed to be weaker. We are weaker there. And maybe that is some of the catalyst for why we've been seeing the stock market move.
Yeah, absolutely. I mean, the dollar, if you take a long-term view, right, it's off like 10 or 11% from its high. But if you back out and look at it even further, it's still pretty heady at these levels. So as Jurrien Timmer told us, he thinks it's going to continue coming down.
All right, as we march closer to those closing bells, just about 8 minutes away, let's bring Jason Pride into the conversation, Chief of Investment Strategy and Research at Glenmede, joining us here in Studio 2. And Jason, I do want to start with how important a rate-cutting cycle is for this market, if at all.
It's definitely important. It's part of the equation for investors thinking through how they're going to value stocks. It affects the economy because lower rates provide that extra little impetus for economic action development by businesses. At the same time, it provides the backbone for valuations. Short-term rates feed into long-term treasury rates, as you were just discussing, which feeds into how everybody values stocks, because that's the competitive asset to bonds.
After the rate cut, there was a lot of talk about maybe the potential outperformance we would start to see out of small caps. We had a couple of days where they did really shine, but I feel like there have been a lot of head fakes coming from that space as of late. And I do wonder what gets people a little bit more confident in going into mid and the small cap space and staying.
And so there's a couple of pieces there. Number one is going to be this rate situation. Lower rates will be more favorable for smaller capitalization stocks. And we haven't seen that pass through yet. We've seen a little bit of lower rates, but we haven't gotten to a level that's really truly helpful for small cap stocks. They finance more at floating rate than other capitalization baskets. The other thing that has to happen is we have to have this broadening out of performance. We need to see strong revenue growth or more reasonable revenue growth across the board, more reasonable earnings growth across the board, rather than just focused in the mega cap tech. Now, we're actually seeing that in the second quarter. Small caps delivering about 18% earnings growth in the second quarter. We can actually kind of claim that is a true number now. They're pretty close to wrapping it up. We have a couple stragglers sitting out there. And the next 2 quarters actually look stronger than that.
One place where you see, one place where you see broad outperformance is planet Earth, right? If you look at regional markets, you have massive gains, even in local currencies, right? Everyone says, oh, that's the dollar, but it's not. In local currencies, the DAX is up almost 20%. The IBEX is up 30%. The Hang Seng is up 30%. The IBOVESPA is up 20%. We're seeing a global bull market right now. Does that continue?
We think so, and we think it is a little bit about the dollar. You know, this broad story is one about kind of global growth kind of resuming at this point in time, not just being about tech, about being other parts of the market, about other businesses actually incorporating AI, getting those efficiencies through and actually showing through on the bottom line. If the AI story is true, we'll start seeing it show up in other companies' earnings, not just the tech companies' earnings. And then as far as the dollar's concerned, look, we have a paradigm here that's shifting from a high dollar situation for the U.S. to one that's probably going to see a gradual devaluation of the dollar. And a devaluation of the dollar should favor all those indexes you're talking about on a U.S. dollar basis.
What kind of economic growth do you see? I had a very important automotive CFO in here the other day, and he was asking me, because he says the visibility is not great, right? Where is the U.S. going to grow next year? Where is the U.S. going to grow in the year after? How contingent is that on the Fed cutting down to the 3% terminal rate that the market's priced in?
So I'm going to give you a very economist answer to this. The next couple of quarters are probably going to still be middling sort of growth, 1 to 1.5% sort of growth, because we're still feeling that pinch from tariffs, and it's just now being passed from companies that were working through cheap pre-tariff inventories on to consumers. Only about 36% of the tariff hit has actually been passed on to consumers yet. So there's basically another 2 times what we felt to come through. But that's the next couple of quarters. Once we get into the beginning of next year, the impact of this fiscal bill starts showing up in spades. We get refunds on top of adjustments to tax bases for consumers, and you've got an acceleration of expensing that hits corporations. Now, they can do that now, but probably we're going to feel a majority of the benefit of that in the beginning of next year. So the beginning of next year will probably be a lot stronger. We're guessing, consensus estimates are only in like the 2.5 range right now. We're probably thinking it's actually 3+ at the beginning of next year.
I mean, that sounds great, and I guess it circles back to kind of the original question as to why start a rate cutting cycle if that is on the horizon. And where does inflation actually end up? Because it's one thing to sort of look at all this and say, great, economic growth, consumer spending and all that. But if inflation starts to creep back up from basically 3% where it is right now, does that become a headwind?
It's going to become a little bit of a headwind. We're actually expecting inflation to tick up by about 0.5% to 1%. The Fed's going to notch that, as they probably will never use the word transitory again, but they will be thinking about it as temporary, as a one-time, one-year effect in the system, not something that's long-term. So they're going to be looking more at the employment market to make their moves on interest rates. And I think the argument there is stronger that we actually need that help from the Fed at this point in time in order to stabilize and just give a little bit of a lift to the employment market, even as we head into that stronger growth that we think we may see at the beginning of next year.
All right, Jason, great stuff. Always great to have you.
Thanks for having me.
Jason Pride, Chief Investment Strategy and Research over at Glenmede, as we count you down to the closing bells. Matt here. It's a kind of interesting day here. We only have about half the stocks in the S&P in the green, but this is, of course, one of those days where it doesn't matter because it's the right stocks are in the green, and a lot of it are the big chip stocks and, of course, the big players in the AI space like Oracle. Oracle's up 7% today.
It's a great point, and of course, they installed a couple of new co-CEOs over at Oracle, which, by the way, pre-market, they were down, and now they've just powered higher. Obviously, NVIDIA saying they're going to invest $100 billion in OpenAI can't do but lift these levels.
And then you have Apple up 4% on the day. Actually, now in the green on a year-to-date basis, primarily because it looks like some of the preliminary read on those iPhone sales are actually positive. We're going to have a full breakdown of all of today's market action and push you ahead to what to look forward to tomorrow. That all starts in our simulcast now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Matt Miller today, here to help take you through the closing bell with the global simulcast. We're joined right now by Carol Massar and Tim Stenovic in the radio booth. Katie Greifeld has the day off. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A third straight session, Carol Massar, where we see the S&P at a record high.
Everything is awesome. Yeah, it's interesting to see the momentum continuing to the upside. I was looking to try and see what groups, but no surprise with NVIDIA. It's big investment in OpenAI. We had some calls from Wall Street, some upbeat ones when it comes to some names in the space. You've got the Philadelphia Semiconductor Index, the SOX, guys, up about 1.6%. So some outperformance there in a big way.
We did just have Paisley Nardini on our program. She's over at Simplify Asset Management, Matt, and she was essentially saying, hey, I'm a little concerned that we're not going to get the rate cuts that the market is expecting, and we could see in the coming weeks, coming months, a little bit of a pullback. She's optimistic in the long term, though, so if we do see a 10 to 15% pullback, she's buying.
You know what's interesting? This morning, I would have thought people were more concerned about this $100,000 visa program. There was a lot of talk about how many IT workers have these H-1B visas and how expensive it might be to reduce that. I think one estimate in Eric Fan's story from last year was that a 10% reduction in H-1B visas would cost the U.S. $86 billion in GDP, but it hasn't seemed to bother investors at all as we move towards the closing bell.
Yeah, just one more thing, I guess, that they just have to trade around, at least for the moment, until we get a little bit more clarity in terms of what actually happens next. But as you take a look at the green on your screen, and maybe ratifies exactly what Matt was talking about. The Dow Jones Industrial Average up more than 70 points, or 0.2%. That's a record high. The S&P 500 up almost 30 points, or 0.4%. That's a record high. The NASDAQ composite up about 160 points or 0.7%. That is also a record high. Meanwhile, you take a look at the Russell 2000, which last week closed at a record high of 2467 and change. It closes just a tad below that, but still higher on the day, up by about 0.6% to close out this Monday.
All right, checking in on the S&P 500, Romaine, you've got almost an even split, even with records on Wall Street. So what does that mean? 245 names in the S&P 500 gaining ground today. 256, Matt, to the downside, 2 unchanged.
Yeah, it's pretty interesting. We've had pretty bad breadth all day long. But as Romaine and I were talking about, it's all about the big tech stocks, information technology, a big green slice of your IMAP pie right now. And after NVIDIA said it's going to invest $100 billion in OpenAI, what else would you expect? That's the kind of announcement that absolutely powers the market higher.
Yeah, exactly. So I'm going to start with NVIDIA, Matt, because that one finishing just off its highs of this session, but still up just shy of 4%. As you said, NVIDIA going to invest $100 billion in OpenAI to support the building of new data centers and the infrastructure needed to power AI workloads. Keep in mind, it's a letter of intent, which is kind of just interesting. So it's a plan. So we'll see how it all plays out. But nonetheless, it did send NVIDIA much, much higher. In fact, the whole semi group was higher, as I said earlier, on a bunch of calls, too, from the analyst community. Hey, I got to go to Oracle, finishing pretty much at its best levels of the session, a gain of more than 6%. This as the company is said to be responsible for the algorithm, the securing of the algorithm for TikTok here in the United States.
You think that's driving the stock higher, TikTok?
You don't think it is?
I think maybe it's because they have 2 new co-CEOs.
You think it's because they have 2 new co-CEOs?
I mean, is TikTok going to really power their earnings higher? It's not the kind of $300 billion order that you get from NVIDIA GPUs.
Hey, where's Katie?
So, where's Katie?
Wow. She's on TikTok at home.
Well, listen, Oracle has this close relationship with TikTok in the United States. So securing and being still involved in that certainly would mean some business momentum for them. I don't know. Everything Oracle does, they seem to be on fire right now. So
I feel like they weren't getting kicked out of the TikTok story.
Yeah.
By the way, the stock has doubled year to date.
I know.
Doubled.
I know, which is why we did like a 10-minute segment on what's going on with Oracle, because they just seem to be everywhere right now.
Okay. This segment is going to be 10 minutes, are we? I mean, there's more other stocks moving.
All right. I've got one more. Ticker is BETR, Better Home. And what is it? Better Home and what?
And Financing Holdings. It's right there on the screen in front of you.
Okay. Well, I've got, not like you TV people who've got stuff. I've got a lot of things I got to do over here. Stock is up about 47% at the close. It was up as much as 175%. This happened as EMJ Capital's Eric Jackson said the hedge fund was long the stock. I mean, this is the guy, behind Open Door, and we saw the momentum there. But this one, I mean, it's not even a big company, is it? I mean, we're talking about a $764 million market cap company. But nonetheless, he came out and said he's long, and investors moved into it.
All right. Those are the gainers. I got the decliners. I'm watching shares of Kenvue actually falling close to a record low, or closing at a record low, down 7.5% today. This after the Trump administration, we learned plans to link the active ingredient in Tylenol to autism and warn pregnant women against using the medication unless they have a fever. We are expecting President Trump to make some comments soon when it comes to this. We will bring those comments to you live when we do get them. Formerly the Consumer Healthcare Division of Johnson & Johnson, by the way, so only a few years as a independent spun-out company, Kenvue that is. Disney shares finished the day down 1%. It was down as much as 2% earlier in the session. It bounced higher a bit after the company said that Jimmy Kimmel Live will return to air on Tuesday, ending a suspension imposed following controversial remarks that he made about the assassination of Republican activist Charlie Kirk. We're getting some more details about that. We are reporting that Kimmel will address the Kirk controversy when he returns to the show. Yes, he will. He will not.
What if he just came back and didn't mention it?
That would be weird. And he will. Also, we learned that he personally negotiated a return with Bob Iger over at Disney, in addition to Walden as well. Disney shares falling by about 1% today. And finally, some M&A news sending shares of Compass, the real estate firm, lower today, down 15.7%. Compass shares fell after the company agreed to buy Anywhere Real Estate. It's a $1.5 billion stock deal. Anywhere has brands including Coldwell Banker, Corcoran, and Sotheby's International Realty. So it's going to be a big player when it comes to the largest residential brokerage in the U.S.
All right, let's get a quick check on yields here. We actually did see yields actually rise today modestly, basically about 2 basis points almost across the curve, 3 basis points on the short end. This despite some of the commentary that we heard a little bit earlier from the Trump's appointee to the Fed governorship, Stephen Myron, giving a speech at the Economic Club of New York, saying that he actually wants to see a more aggressive rate cutting cycle to protect the labor market. And then we have heard from Beth Hammack and a few other Fed members kind of saying, well, maybe not. Let's hold off here. So interesting to see who the market's paying attention to right now, which seems to be more on the cautious side than anything else.
All right. So let's get to some chats that were on our radar. And Walmart is adding home delivery for things like Ozempic and other refrigerated drugs. Apparently, they've offered refrigerated drugs at Walmart, but you usually have to go in and pick them up. But
refrigerated drugs?
Yeah. Well, Ozempic,
got to keep it in the refrigerator.
You have to keep it in the fridge.
Oh.
Yeah, things like insulin, got to keep in the fridge.
Oh, okay.
Amoxicillin, got to keep it in the fridge.
Okay,
so usually you could go and pick it up at a Walmart, but now they are actually delivering it to your door.
Yeah, they've got specialized insulated bags that can be delivered in as fast as 30 minutes, along with groceries and other products in a single online order. The company says it can now deliver 90% of prescription medications in 49 different states.
Wonderful. You know, it's funny. You know, I live in one of these fancy apartment buildings in New York City where you get everything delivered. They actually put a refrigerator in the package room because I guess people are getting deliveries of various drugs and things that they need.
The rise of delivery has wreaked havoc on. This is a very New York City centric story, but it's wreaked havoc on doormen and their jobs because they're now basically in charge of just coordinating package delivery to individual apartments. And if you don't have somewhere where you can store refrigerated things, then it makes it very difficult to get those groceries to you without them spoiling.
So that's our interesting story. What do you have?
Well, speaking of weight loss, you actually need to come down a little bit. Your shot's a little bit out. Your head's a little bit out of the shot, Carol Massar. But, when we talk about the Oura Ring, you talk about your health. I have one. I think Tim's right. Tim's a healthy guy as well. $11 billion valuation on this company now after their latest fundraising round, and really raising a lot of questions as to kind of where this company goes next. It's basically a single product company, obviously a wildly popular single product company, but the big question is how do you evolve from this?
I think it's interesting. One thing that you do is you make a deal with American Express.
Yes, I was just thinking
Have you seen the Platinum card? So it's going to cost more, I think, to get the card, but one of the perks that Amex is offering you is you can get $200, $300, $400 off of your Oura Ring. How much these things cost. And nearly everybody has now one of these kind of fitness measurement devices. If you don't want to wear the ring, you have the Whoop Band. If you don't want the band, you have the Apple Watch. If you don't have that, you have the Fitbit.
Samsung.
But Matt, what's not included in that is the subscription fee that you have to pay to get all the features of this, right?
Wait, you have to buy for Oura the hardware and have a subscription?
Yeah, that's why it makes sense to give away the hardware for free, $6 a month.
Yeah,
that's how they get you.
Or about $70 a year. So it kind of makes sense. They want to get as many of these things out there so people are just paying that subscription fee.
Or you could just go exercise, folks, and just do it.
How do you know how hard you're working?
What is wrong with Carol?
I don't know if I've had enough strain, right? Or if I've recovered well enough to hit the gym. That's why you have to have the Whoop, which, by the way, you only pay a subscription. They never upcharge you for new hardware, except when they do.
All right. I think your Whoop's telling us we have to go.
All right,
my heartbeat is, going on right now.
And I bet you've got something to measure it, which is so wonderful.
I do. My blood oxygen level going through the roof.
I'm so happy. We want to make sure you stay healthy. All right, everybody, that is a wrap. Our cross-platform coverage, radio and TV.
Over this.
Over us or over this?
Over everything. It's been a good run.
All right, good to know, good to know. All right, guys, that is a wrap. They're going to continue over on the close, and we're going to continue on Bloomberg Business Week Daily. Maybe they're going to continue. I don't know. It sounds a little sketchy. We'll see you again, same time, same place tomorrow.
And our coverage does continue here on Bloomberg Television. A conversation about that big move in the AI trade when we come back after the break. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic, and you take a look at the screen behind me, and that is record highs pretty much across the board for U.S. equities. The 28th record high for the S&P 500 this year as the AI trade, the tech trade really, if you will, starts to pick up or reignite on this Monday afternoon. Curiously enough, you actually saw a bid into some safe haven assets like gold, which also traded at a record high on the day. Remember, typically you do not necessarily see that one-to-one correlation between equities and gold, but nevertheless, that's where we are. Bitcoin pulling back here on this Monday afternoon. As far as some of the individual stories out there, we are keeping an eye on Kenvue. This is the maker of Band-Aids and, more importantly, Tylenol. It was spun off of Johnson & Johnson, of course, back in 2023, and now at the lowest level since that spin off. Some concern here about the potential for a report by the White House, by the Trump administration, that would link the main ingredient in Tylenol, acetaminophen, to autism. We're actually waiting for a statement by the White House at some point later this afternoon. We'll have full coverage on that as soon as it happens. Disney pulling back about 1% here as the controversy over the fallout over Jimmy Kimmel continues, and keeping an eye on the tech space. Look at this, a 4% jump for Apple. And we should point out, prior to today, for the entire stretch of this year, Apple had been in the red on a year-to-date basis. The gain today now pushes it into the green, and Applied Materials getting a strong bid. This is the maker of wafers for the semiconductor equipment sector. That also getting a strong bid on the day as well. And that actually brings us to our top story, and it is the resiliency of the big tech trade. NVIDIA today back at a record high. It's first since mid-August, and that's notable because the profit-taking and pullback that we had seen in that name over the past 5 weeks, well, that was largely a function of concern that the AI trade had run out of steam. Basically, that investors and AI spend by corporations had actually peaked. But news last week, the Oracle is in discussions with Meta for a $20 billion cloud computing deal. And news today that NVIDIA will progressively invest $100 billion in OpenAI is causing a rethink of the rethink on the AI spend. And of course, it doesn't hurt that the White House's statecraft for now seems to be favoring big tech. So for a lot of investors, the question is that, well, it will, with tech stocks at record highs and, of course, historically high earnings multiples, why would you even try to swim against that tide? Joining us right now for her insights is Kim Forrest, the founder and chief investment officer over at Bokeh Capital Partners. And I do want to start there, Kim. A lot of people were starting to write off the tech trade just a little bit. I am curious, when you look at the spend and you look at, I guess, this idea that the White House seems to be all on board with a lot of it, does that give you enough confidence that this trade will continue even higher?
Well, I mean, the question is for how long, right? I think we do have some runway ahead of us. The investor class and just regular people love playing with LLMs, large language models. And so they're kicking the tires on things like OpenAI and Gemini, and then, you know, a whole host of others. But OpenAI was the first, and so far, a pretty good number one, you know, pole position whenever you think AI. And today's news about NVIDIA investing in OpenAI, which is really investing in itself, you know, that should give you a little bit of cheer, but also a little bit of pause, because they really are self-funding, right? Yeah. I mean, that's the way I look at this. And so that gives you comfort that they have enough money to invest in themselves through OpenAI, but it's still, you know, kind of taking from one pocket, putting it in the other pocket.
Well, I'm glad you bring that up, because this isn't the only relationship like that. We've seen this with a few other companies out there as well, CoreWeave and a couple others that I'm forgetting about. That this idea that there is a bit of self-dealing here. Now, I know, at least for right now, it's beneficial to both companies and for now beneficial to investors. But what is the end to that? At some point, I assume this breaks free from that, right?
One would hope, right? Because what you really want to see is a use case. Oh gosh, do I sound like an ex-software engineer? Yes. A use case where all of these hundreds of billions of dollars invested in building out the infrastructure in AI actually begin to pay off in productivity. Did I mention that bad word, productivity? Right now, it looks like to build out these things is so expensive. I'm still not sure what problem it is that they're solving, other than people really didn't like to use Google to search. It's much more fun to use OpenAI or another large language model to be able to search and get a good answer.
Well, I mean, the bulls would say, okay, at some point this broadens out, right? That if the AI story isn't about data centers and chips. It's about, the financial company that uses it to, presumably cut jobs and improve productivity, or other companies that find a way to make their operations more efficient. Do you not see maybe a plausible bullish case in that?
Well, not right now. And I hate to be really this down on it, because I love AI. I used to make AI. I understand AI, but I'm looking at the output of these systems, and a lot of them are just too wrong to replace humans. It really is an issue. And I'm not sure that they will ever get there in this current incarnation of large language models. I think what they've done, any of the makers playing in this space, have kind of solved the problem of computers understanding natural language. That's awesome. But don't mix that up with thinking machines. They are not. There are other things that we can do using the same sort of techniques, answering or creating solutions for narrower problems. And that is where I think the productivity comes. So I'm not a believer that we're going to have, all the data centers that they currently are anticipating, all of the chip sales, even through the year 2030, because what they're right now is betting on scaling, adding more, just feeding more data into these machines to make them smarter. And I don't think that's the way to go. And a lot of computer scientists back me up on this.
Well, yeah, and we should point out for our viewers that aren't familiar with their background. I mean, you did start your career in this space before you went into investing. But I am curious. I had a chance to catch up with Geoffrey Hinton earlier today, who won a Nobel Prize of last year for the work that he and others, as he points out, did in kind of laying the foundation for this. And I did ask him specifically about this race to superintelligence, the AGI, and the idea of how close we are, and more importantly, how reliable it is. And he had a lot of caveats about when we get there, but more importantly, that once we get there, what does it actually look like? And I am curious, you seem to be kind of, I don't want to mischaracterize, a little bit in the skeptical camp as well.
I'm hugely in the skeptical camp. I don't think we have to bounce around about that. Again, I think neural networks are phenomenal, and Geoffrey Hinton got acknowledged for his role in creating that, way to program. I think it's brilliant. It works. But I don't know that we can replicate the human mind by reading the internet. I mean, and that's essentially what they're doing. Okay, maybe they're going to throw a few books in there as well. But I don't think the human experience lends itself, or maybe it's the computer experience lends itself to be able to understand even what or the average human does. It's just a lot of data, and it's the way the thing is structured. You can't weed out the parts of the machine that are reporting bad answers quick enough. That's the issue, to be able to get reliable answers. But humans learn, no, apples don't fall upwards, they fall downwards. Do you see what I'm saying? That's a stupid, trite answer, but everybody knows that.
Yeah, I see what you're saying, and we need to have a longer conversation about this, because it really gets deep. We're out of time, though, Kim. Always love talking to you. Kim Forrest is the founder and chief investment officer over at Bokeh Capital. When we come back, we're going to refocus on Kenvue. Stick with us. This is The Close on Bloomberg. Kenvue, that was the consumer products unit spun out of Johnson & Johnson a few years ago, closing now at the lowest level since that spinoff. This on the back of reports that the Trump administration plans to link the active ingredient in Tylenol, acetaminophen, to autism and warn pregnant women against using the medication. Joining us right now to talk about the potential implications for the company and on the stock is Susan Anderson, a managing director and senior analyst at Canaccord Genuity. She has a buy rating on Kenvue. All right, Susan, I know there's a lot we don't know, and we are still waiting to hear from the Trump administration today on exactly what they plan to recommend. I am curious, if we do know that this is primarily targeted at a recommendation towards pregnant women, does that mean that maybe the sell-off that we've seen in this stock over the past few days is overdone?
Yeah, we think it's overdone. Tylenol pregnant women is not necessarily their audience, right? They don't market to pregnant women. It's just really the only known drug out there that, for now, the FDA is saying is safe to use while pregnant for pain or for fever. And so, I think it's the go-to drug if you absolutely need to take that while pregnant. But it's not, Tylenol's primary audience. We think it's probably 1% or less of sales out there. So, I think the bigger risk for Kenvue and for Tylenol is really if the public opinion of the drug, starts to sway in a way where other consumers start to become concerned using Tylenol, and then that could potentially impact sales. Or if the lawsuit that we saw back in 2023 get thrown out, it's right now in appeals court. If that is able to come back in a new form, then, there could be some more risk to Kenvue financially. But, just looking at the population of pregnant women alone taking Tylenol, it's pretty small.
But you raise a broader point, though, about this idea that even if this is an order that is directly targeted at recommendations for pregnant women, there are still people that might extrapolate overall that somehow it's not safe and stop taking it. And we're talking about a company that has been through a lot over the years. I'm old enough to remember, the cyanide lacing scare back in the 1980s. But I'm also old enough to remember how well, or at least at some point, how well the management there at Johnson & Johnson at the time managed to navigate through that. Have you had any discussions with management about how they might handle the potential public fallout from this?
Yeah, so, I think that it's not going to be anywhere near what we saw in the 80s. They've already been through a lot, like you said, and they've been through this entire lawsuit in 2023. So it's pretty well known already by the public. And, from what I've heard, I think the new study, well, it's basically just a reinterpretation of an existing study, but I think it's still not going to be able to link autism to acetaminophen or Tylenol. I think there's going to maybe be, some closer analysis done. And from, what I've heard early on, I think it's going to be, maybe prolonged usage. They've, been able to tie it a little bit more closely. But if I had to guess, I think there's probably going to need to be some further studies done. So, I think that it's already pretty well known in the public's eye around acetaminophen and autism, the linkage with pregnant women. And so I think it's nothing new out there. And I don't think it's going to be, anywhere near as damaging as what we saw in the cyanide case.
All right, Susan, always appreciate it. Susan Anderson, Managing Director and Senior Analyst over at Canaccord Genuity, keeping an eye on shares at Kenvue, down 7% during the cash session today. And of course, now back down to the lowest level since they were spun out of Johnson & Johnson back in 2023. We are awaiting right now to hear from the President of the United States. Down there, you can see at the bottom of your screen, a shot of the Roosevelt Room in the White House, where they are expected to make an announcement about a, quote, significant medical and scientific findings for America's children. They have not confirmed reports about what they will say specifically about Tylenol, but most of those reports now have completely overtaken this market. We'll have that coverage of that as soon as it happens. And when we come back, we're also going to talk about what's going on the economic agenda. We are expecting to get an update on what happened in the latest round of U.S. GDP reports and a fresh read on monthly PCE, a conversation with Michael Feroli, J.P. Morgan's chief U.S. economist. He joins us when we come back after the break, right here on The Close, right here on Bloomberg. All right, welcome back. Today, 40 years ago, one of the most consequential moments in international finance unfolded in secrecy at the famed Plaza Hotel overlooking Central Park in New York City. It was there, September 22nd, 1985, when the UK, France, Japan, and West Germany joined forces to formally help the United States devalue the dollar. It was a day of intrigue that began shortly after midnight when the Treasury Department confirmed news reports that the finance ministers and central bank heads of the 5 leading non-communist industrial nations would meet that Sunday. The Treasury refused to share details, but the meeting came one day before President Ronald Reagan was scheduled to make a speech proposing measures to promote U.S. exports. Now, remember, the U.S. was in a bit of a bind at the time. The U.S. had largely through its own monetary policies had seen the dollar depreciate by more than 60% in the early 1980s. That made U.S. goods too expensive for overseas buyers. The trade deficit widening to a record, the U.S. manufacturing sector squeezed, and Congress had started to threaten haphazard trade interventions. At about 3 p.m. on that Monday, September 23rd, the finance ministers issued a communique in a very stilted language that laid out the case for how exchange rates play a role in adjusting external trade imbalances and said that they stood, quote, ready to cooperate on the orderly appreciation of the main non-dollar currencies to better reflect fundamental economic conditions. For days following this so-called Plaza Accord, there was confusion as to how exactly this would all work out. The market actually ended up doing a lot of the heavy lifting, though, that would have otherwise involved the Treasury actively buying and selling currencies, to push down the dollar. Over the next 3 years, the dollar would indeed slump intentionally by more than 40%. And while the Plaza Accord was fraught with many pitfalls that would largely see the deal unravel a few years later, it still stands as a landmark of economic cooperation by individual nations to directly confront a global problem. The dollar to this day has never regained the pre-Plaza Accord highs. And that meeting on this day 40 years ago would develop into what is now the G7 Finance Ministers Group, which has continued to meet every year since. And that brings us today to the dollar, failing to hold on to its 3-day gain as the market tries to digest today's Fed speak, including from Cleveland Fed President Beth Hammack, who characterized inflation as too high, but said the central bank must be cautious on its easing path. Joining us right now is Mike Feroli, J.P. Morgan's chief U.S. economist. And of course, Hammack's comments come on the same day that we also heard from the newest Fed governor, Stephen Miron, who made it clear he would actually like to see a more aggressive rate cutting cycle, in his words, to protect the labor market. Who wins out here?
Well, I think in the near term, certainly Hammack's view, which is for continued gradual easing of policy, seems to be really the majority view on the FOMC. So I think Myron's view for more aggressive rate cuts has little prospect unless we really see a really market deterioration in the labor market in the next few months. Other than that, besides that, you saw a fair amount of consensus on the committee last week for, if easing at all, to ease at a pretty gradual and cautious pace.
One thing that I thought Myron brought up, and other economists have brought this up, is about where the neutral rate is, whether conditions are actually currently restrictive or not, and the idea of what kind of inflation rate can we live at.
Yeah. So I think it's interesting, the point about the neutral rate, because as you mentioned with the dollar, that has been generally declining. Financial conditions are quite easy. Stocks hit a new high today. So the argument that policy is really restrictive seems at odds with a lot of financial conditions we're seeing. Now, that being said, there is an argument. I think the argument that Myron made was that slower immigration growth should also mean slower trend GDP growth. He didn't quite say it that way, but I think that was the case he was trying to make. But I don't think there's really big buy-in on the committee for making an aggressive series of policy moves based on the neutral rate, which is anyone's guess really where that is.
With regards to where we stand in the economy, we're going to get another read on PCE, we're going to get an update on GDP, but recent data seems to suggest that things are okay, if not necessarily great.
I think that's exactly right. Outside of the labor market, we're seeing GDP growth continue to look fine. Retail sales we saw last week was fine. It's really just that job growth has slowed quite a bit, and a lot of that does come back to immigration and slower trend growth in labor supply.
But draw the distinction. It's one thing to say job growth is slowing, but people aren't necessarily losing their jobs, or are they?
That's right. No. So overall gross hiring has slowed. We haven't seen a pickup in layoffs either in the monthly data or the weekly jobless claims data. So it looks like a maturing business cycle, but not one that is cracking or showing signs of distress in the business sector. The good news of all this, of course, is slower labor growth and higher steady GDP growth means arithmetically good productivity growth. And that has looked a little better through the second quarter. And if things continue this way, I think the third quarter will be another good productivity growth quarter.
There was also been a lot of talk about wage growth and the idea that, at least by certain measures, wage growth has kept up, if not outpaced, inflation. Is that your read?
So right now, I think wage growth is kind of in a sweet spot. So it's running between 3% and 4%, which is consistent with productivity growth where it's been, and 2% inflation. So I think We probably haven't caught up to all the price gains that had occurred in 21, 22, and 23. But I think at current trends, this is actually, a really nice equilibrium in the labor market.
Do you anticipate, though, that could change next year? On the inflation side, are you anticipating any sort of price shock from tariffs, or is this going to kind of be smoothed out?
Yeah, so we don't think we're done here with the tariff pass-through, right? We saw it in the most recent CPI report, we believe, and we think, as we said, we're not done. A lot of businesses are telling us that this is something that they're going to continue to pass along. I would expect as we get into next year that we start to fade out of some of these higher tariff pass-through, particularly into goods prices, and that inflation moderates next year.
When we talk about the CapEx spend that we've seen and just the idea of business spending, I know this is economy still driven by the consumer.
Yeah.
But I do wonder, I know that's been fuel for the stock market,
Sure.
the business spending. How much of that is responsible for kind of keeping the normal economic numbers that we look at afloat?
Yeah. So certainly, the first half of the year, one of the bigger surprises has been the strength in capital spending. And initially we thought it may have just been pulled forward ahead of the tariffs, but that has really continued past that initial shock. It is true that a lot of the CapEx we're seeing is in the tech space, so we're really kind of flying on one engine in that regard. Outside of tech, you don't see really notable CapEx numbers. So I do think the AI boom, likely AI boom, when we strip it out of the data, is really what's powering CapEx. And CapEx, as I said, has probably been the part of the economy surprising us.
Well, how do you sort of measure what the potential impact of this AI boom, whatever we want to call it? Because there are a lot of people that say, look, this isn't just about the tech companies. At some point, this becomes, if you believe them, a productivity story.
Yeah.
Also, it's like you build data centers, so that's construction jobs.
Right.
That there is sort of a read-through to other parts of the economy that at some point should have an impact.
Right. So the easy part is, the building of the data centers and what that's mean for the economy. Probably added about a half point to first half GDP growth annualized. I think the bigger question is how much, and another thing I would say that we think we know is, and we look at productivity by industry, we don't see a lot of distinction relative to AI intensity. So far, the productivity we're seeing, we don't think is AI driven, or primarily AI driven. I think the biggest question is, as we look ahead to the next 1 to 5 years, what kind of productivity we're getting. And I must say, the estimates there, which are really just guesses, are all over the map.
Well, I mean, productivity hasn't really been a story, at least I can't remember in my life. I remember when I first started my career, my boss would always tell me to look at productivity. They were actually something to look at then, and then at some point, those numbers never budged.
Right.
And so, do we need that in this economy? I mean, we've gone how many decades without any real meaningful uptick in productivity?
So probably the last time we had real good productivity growth was late 90s, early 2000s.
Yeah.
The decade after the GFC was very bad productivity, and that was probably a decade of bad feelings when it came to the economy. So I do think, on a multi-year horizon, people feel good or bad about the economy based on productivity growth. Maybe not, month to month, that's going to be the stock market and everything else. But for really strong, long stretches, it is going to be productivity that I think drives how people feel about the economy.
All right. Great stuff as always, Mike. Michael Feroli, J.P. Morgan's chief U.S. economist. A closer look here at economic conditions. And we do just want to point out there at the bottom of your screen, we are waiting to hear from the President of the United States on what they're calling a significant medical and scientific finding for America's children. Several news reports out there saying that this could have to do with autism and any potential links to certain drugs out there on the market. We'll keep an eye on that and bring you full coverage of that as soon as it happens. We do want to take a quick check here on the markets, though, particularly in the after-hours space here, as we are seeing some modest movement in Kenvue. Remember, those shares had fallen more than 7% during the cash session, getting a modest bid of about 9%, 0.9% here in the after-hours session. We should point out Teva also higher, and we should keep an eye on that stock here because there has been some rumors here about a potential drug that the administration might be recommending as a potential to combat autism, a drug that Teva Pharmaceuticals actually makes. Disney shares slightly lower on the day, as is Warner Brothers. And we should point out, we're also seeing some activity in Firefly and Portillo's. Stick with us. This is The Close on Bloomberg. It's Climate Week here in New York, the world's biggest confab, bringing together business leaders and policymakers for high-level discussions on climate action. One company at the center of it all is the electrical engineering giant ABB, which helps companies function more efficiently and reduce their carbon footprints. I had a chance to catch up with Brandon Spencer, who is the president of ABB Motion, and he talked about his company's goals during this week.
We're here with surrounded by thought leadership and really trying to show what ABB is doing, our product solutions and services to help decarbonize, drive energy efficiency, and really help lower the emissions footprint. So it's a great opportunity for us to be with our customers, policymakers, everyone, and really kind of have a seat at the table.
I am curious about what the connection is or correlation is right now between what corporations are looking to do on that front and policymakers. We've seen a pullback, of course, here in the United States from various global climate accords. We've also seen a lot of companies now back out of some of those commitments as well.
Yeah, for us, it's important to have a high say-do ratio. So if you look at our facilities, we just spent $100 million opening up a facility in New Berlin, Wisconsin. You know, geothermal, solar power, zero waste to landfill, these kind of things. And so for us, there is a business case behind it. And it's important that we show our customers that we're doing it while also help offer the solutions for them to do it. And so while, you know, policies change and you know, there's waves and flows with that, we think staying consistent and really driving the business case for these changes is important.
Have you seen sort of a shift in the way that these types of programs are talked about or marketed? It seemed like a few years ago it was all about saving the environment, saving the world.
Right.
There was always a business case there, but I am curious if that now has to be front and center.
Yeah, I think you have to go good for the wallet and good for the planet. And so I think maybe in the past it was a little bit the reverse of that. And so we see a higher focus on the business case for it, justification of it, but still an attitude and a desire to do it. And certainly for us, that's something we're proud of at ABB.
And of course, for those folks who aren't familiar with ABB, you guys effectively help a lot of other companies sort of build out more efficient buildings and facilities and things like that as well. Where is the primary focus right now? Are there specific industries or specific types of structures and facilities that you're focusing on?
I mean, we're very diverse. Data centers gets a lot of attention these days, of course, in the energy demand and these sort of things, but we're very diverse in terms of the industries that we serve. So it could be marine, energy-intense industries, power generation, data centers, food and beverage, across the spectrum. And really, ABB, we're there to automate them, digitalize them, and electrify them. That's what we're there to do. And so energy efficiency, key thing that we're talking about during Climate Week.
Is that more difficult now, particularly in light of data centers? I mean, just earlier today, before this interview, there was yet another big investment announced in the AI space, one that ostensibly is about the power rather than just the actual computers and servers themselves. What is that business looking like right now?
Yeah, I mean, look, a strong growth curve obviously happening in building out the infrastructure for these. How do you get them online? You know, we have technology that's assisting with that in order to speed up getting power to these facilities. And if I go back to energy efficiency, we can put 10% capacity back on the grid just by using technology that's available now. And so we're also talking to customers about that, because it's not only new and waiting for new products and new offerings, it's let's use some of the offerings that we have available today in a more intelligent way in order to have less emissions and more energy.
Is that about sourcing the power, or is it storing the power that you already have?
Sourcing the power, yeah. I mean, storage is an up-and-coming topic, but you know, for the size of these facilities, when you're talking gigawatts and these sort of things, huge facilities, you know, enough to power hundreds of thousands of homes, storage is a little bit more challenging. And so more it's about sourcing and kind of helping generate that in the most efficient way.
Are there concerns that you're hearing from some of your clients or even potential clients about some of the stress on the grid and maybe fears that they won't have enough power to fuel their centers?
There's a couple topics. I mean, timing, you know, so how long till you can get a grid connection and these sort of things. We have a lot of customers talking about behind the meter. So what can they do to generate their own energy?
Brendan Spencer over at ABB speaking a little bit earlier. Let's go down to Washington, where the President of the United States is making an announcement.
I want to thank the man who brought this issue to the forefront of American politics along with me. And we actually met in my office, is it like 20 years ago, Bobby? It's probably 20 years ago in New York. I was a developer, as you probably heard, and I always had very strong feelings about autism and how it happened and where it came from. And he and I don't know, the word got out, and I wouldn't say that people were very understanding of where we were, but it's turning out that we understood a lot more than a lot of people who studied it, we think. And I say we think because I don't think they were really letting the public know what they knew. Thanks as well to the director of the National Institute of Health, Dr. Jay Bhattacharya, FDA Commissioner, Dr. Marty McCary. These are great people. Administrator of the Centers for Medicine and Medicaid Services, Dr. Mehmet Oz, and Acting Assistant Secretary of HHS, Dr. Dorothy Fink. So thank you all. Thank you, Dorothy, very much. The meteoric rise in autism is among the most alarming public health developments in history. There's never been anything like this. Just a few decades ago, 1 in 10,000 children had autism. So that's not a long time. And I've always heard, you know, they say a few, but I think it's a lot less time than that. It used to be 1 in 20,000, then 1 in 10,000. And I would say that's probably 18 years ago. And now it's 1 in 31, but in some areas it's much worse than that, if you can believe it, 1 in 31. And I gave numbers yesterday. For boys, it's 1 in 12. I was told that's in California, where they have for some reason, a more severe problem. But whether it's 1 in 12 or 1 in 31, can you imagine? That's down from 1 in 20,000 and 1 in 10,000. And now we're at the level of 1 in 12 in some cases for boys, 1 in 31 overall. So since 2000, autism rates have surged by much more than 400%. Instead of attacking those who ask questions, everyone should be grateful for those who are trying to get the answers to this complex situation. And the first day all of these great doctors behind me were there, I told them this is what we have to find out. Because when you go from 20,000 to 10,000 and then you go to 12, you know there's something artificial. They're taking something. And by the way, I think I can say that there are certain groups of people that don't take vaccines and don't take any pills that have no autism. That have no autism. Does that tell you something? That's currently, is that a correct statement, by the way?
There are some studies that suggest that, yeah, with the Amish, for example.
The Amish, yeah, virtually. I heard none. See, Bobby wants to be very careful with what he says, and he should, but I'm not so careful with what I say. But you have certain groups. The Amish, as an example, they have essentially no autism. First, effective immediately, the FDA will be notifying physicians that the use of let's see how we say that. Acetaminophen. Is that okay? Which is basically commonly known as Tylenol during pregnancy, can be associated with a very increased risk of autism. So taking Tylenol is not good. All right, I'll say it. It's not good. For this reason, they are strongly recommending that women limit Tylenol use during pregnancy unless medically necessary. That's, for instance, in cases of extremely high fever, that you feel you can't tough it out, you can't do it. I guess there's that. It's a small number of cases, I think. But if you can't tough it out, if you can't do it, that's what you're going to have to do. You'll take a Tylenol, but it'll be very sparingly. It can be something that's very dangerous to the woman's health. In other words, a fever that's very, very dangerous, and ideally a doctor's decision, because I think you shouldn't take it. And you shouldn't take it during the entire pregnancy. They may tell you that toward the end of the pregnancy, you shouldn't take it during the entire. And you shouldn't give the child the Tylenol every time he's born and he goes and has a shot. You shouldn't give a Tylenol to that child. All pregnant women should talk to their doctors for more information about limiting the use of this medication while pregnant. So ideally, you don't take it at all. But if you can't tough it out, or if there's a problem, you're going to end up doing it. The other thing that I can tell you that I'll say that they will maybe say at a little bit later date, but I think when you go for the shot, you do it over a 5-time period. Take it over 5 times or 4 times, but you take it in smaller doses and you spread it out over a period of years. And they pump so much stuff into those beautiful little babies. It's a disgrace. I don't see it. I think it's very bad. They're pumping, it looks like they're pumping into a horse. you have a little child, little fragile child, and you get a vat of 80 different vaccines, I guess, 80 different blends, and they pump it in. So ideally, a woman won't take Tylenol. And on the vaccines, it would be good instead of one visit where they pump the baby, load it up with stuff, you'll do it over a period of 4 times or 5 times. I've been so into this issue for so many years just because I couldn't understand how a thing like this could happen. And it's artificially induced. It's not like something that when you go from all of those, healthy babies to a point where I don't even know structurally if a country can afford it. And that's the least of the problems. To have families destroyed over this is just so terrible. I also, and we've already done this, we want no mercury in the vaccine. We want no aluminum in the vaccine. The MMR, I think, should be taken separately. This is based on what I feel, the mumps, measles, and the 3 should be taken separately. And it seems to be that when you mix them, there could be a problem. So there's no downside in taking them separately. In fact, they think it's better, so let it be separate. The chicken pox is already separate because when that got mixed in, I guess they made it 4 for a while, it really was bad. So they make chicken pox. Individually, they're okay. When you mix them, something maybe happens. So there's no downside in doing it. It's not like, if you do it, bad things. No, it's only good side. And it may not have that much of an impact, but it may have a big impact. So let those be taken separately. And then hepatitis B is sexually transmitted. There's no reason to give a baby that's almost just born hepatitis B. So I would say wait till the baby is 12 years old and formed and take hepatitis B. And I think if you do those things, it's going to be a whole different, it's going to be a revolution in a positive sense in the country. The FDA will be updating the label of an existing drug to reflect potential benefits in reducing some autism symptoms. This gives hope to the many parents with autistic children that it may be possible to improve their lives. That's one of the things that I'm very, very happy about. I mean, this was mostly going to be on how not to have the child affected, but we've learned some pretty good things about certain elements of genius that can be given to a baby, and the baby can get better, and in some cases maybe substantially better. Not going to be easy, but be a lot easier if it didn't happen in the first place, as these great parents fully understand, right? They fully understand. I feel so terribly for. I have so many friends with autistic children. It's a tough situation. Finally, to help reach the ultimate goal of ending the autism fever, the NIH will be announcing 13 major grant awards from the Autism Data Science Initiatives. And to be honest with you, to me, that's the least important. It's not even a money thing at this point. There's so much money, but they have to do, and they have to move quickly. When the alternative is that nothing bad can happen, let's do it now. I was just saying to Bobby and the group, let's do it now. Nothing bad can happen. It can only good happen. But with Tylenol, don't take it. Don't take it. And if you can't live, if your fever is so bad, you have to take one because there's no alternative to that. Sadly, first question, what can you take instead? It's actually, there's not an alternative to that. And as you know, other